of July. If you are in the UK, it is currently about 7 p.m. and it's 2 p.m. in nice sunny Florida. If I say it was sunny, I'd be lying. It's thunder and lightning in the background. So if you do hear some cracking, that's not me falling off chairs. That is genuine lightning going on behind me. So good evening, everyone, for joining us tonight on this property expert panel. And I have wonderful panel members joining me tonight. So I shall let them introduce themselves very quickly whilst we're going to the questions. So Bronwyn, why don't you start, and then Teresa, then the guys can follow.
Good evening, everybody. I'm going to apologise for one of our members. That's Ross Maynard, who's my builder. He's busy on one of the properties because there's been a water leak, but he will try and join us. So my name is Bronwyn Verncombe. I'm a landlord in Hampshire, in Southampton. I have HMOs, holiday lets, small developments and guest houses. But most of all, I love to help people learn. And I have an online program of learning that I will talk about a little bit later. But this is all about education today. It is a free event, and I'm just thrilled that I've got all my power team around me today because I rely on them. So let's move on to my mortgage broker, Simon.
Oh, there we go, guys. I have myself muted there. So professional as ever. Yes, I've been involved in property investing over 20 years. We specialise in commercial and creative finance deals, but we also do normal buy-to-let mortgages. Really, the idea is, I bring creative strategies and make creative strategies work and happen effectively. And once you've managed to get those creative strategies to work, you probably want to reach out to a solicitor, and maybe our resident Tim Bishop could be your man.
Thank you very much, Simon. Yes, my name's Tim Bishop. I own a medium-sized law firm called Bernalick and Bishop. I've got about 65 staff, and we cover everything you'd expect, but we specialise in property, and in particular, we have a property investment team acting for investors and developers nationwide. We also have a highly specialist leasehold team. With experience in commercial conversion and 8-bed HMO. And this week, I'm finally hoping to buy an 11-bed B&B to convert into an apart hotel. But it's been slow work, and the lenders are partly to blame, with some very slow solicitors. But Simon Hodgson is sorting me out, so exciting stuff. Anybody else? Was that over to Teresa? Have we heard from Teresa yet?
No, not from me yet. Hello, good evening, everyone. My name's Teresa Kaczmarek. I'm here representing the National Residential Landlord Association. So this is like a member organisation which you sort of join on an annual basis, and then you have access to resources and advice on everything relating to being a landlord. So yes, that's what I'm here for this evening. So if you've got any questions relating to being a landlord or wanting to be a landlord, then please fire them at me.
Brilliant. So I think we're just left with our tax advisor now and our host. Over to Simon, who is on mute. Don't we love this?
Can you hear me now? I think
yes.
For whatever reason, I do apologise, because I tell you what, the thunder and lightning is causing mayhem with technology. So this would be very, very interesting indeed. Yes, so good evening, everyone. My name is Simon Mishevich. I am here to save you on your tax. So if you have any questions on taxation, please do ask away, much to the delight of Simon Hodgson, so you can take the questions off himself onto me. What we will do is, if you are live, of course, then please feel free to put those questions to us live, and we shall do our very best to give you the answers that you need whilst investing in property with confidence and comfort. And what I'm going to do, first of all, is go straight to a question, which is a question that we didn't answer in the last session, I believe. So hopefully we can get Susie to be answered now. Where do I start in investing? A simple buy-to-let flat, or should I maximize my funds and buy a bigger property? I think we can all have a go at this one, can't we, really? I think we've all invested. So why don't you start, Bronwyn?
Okay, so Susie, when you're starting out, it's really important to be in your sort of comfort zone and not overstretch yourself. That could be personally in terms of your risk profile, but also in terms of funding. So I would certainly have a conversation with you around how much money have you got available to you? What are you comfortable with? In terms of getting a mortgage, I would advise you to have a chat with Simon and find out how much you could borrow. When you're looking at flats, of course, I'm sure Tim will mention this, but you have to look at the lease. So you need to understand the basics really about investing in property and have a little bit of knowledge under your belt. But I would certainly start small, start with something that's comfortable, and you can move on from there, maybe get a couple of properties for the same amount that you've got. But over to someone else to give their views.
Yeah, can I just put something into the pot? I mean, I would, as a first-time investor, I would say steer away from properties where it's going to be a house in multiple occupation. So ideally, I mean, I actually went straight for a house in multiple occupation, and I found out the hard way. But yeah, if you can just go for a single let property, just to give yourself, you know, so you're not too hard on yourself, because if you go down the house in multiple occupancy route, basically it's a massive learning curve. You've got lots of tenants on different tenancies, and then you've got the council wanting you to have all sorts of fire safety measures in the property. So yeah, single let, I would say, to start with. Anybody else?
I might chip in. I think as difficult as this is going to be, Susie, you kind of need to almost start with where you think the end is going to be and maybe work backwards. And that would really dovetail into a great tax question. Sorry, Simon, had to do it. Because tax, you know, in terms of where you're going to end up, whether you're going to be a part-time property person, a full-time property person, will determine how you get those first mortgages, whether you might put them in personal names, in a limited company, or whether you stagger them. And it's quite a complex situation, but not too difficult to work out as long as you kind of approach it on your own basis. Whatever I would suggest is do not go out there and Google it. Should I set up a limited company? Because quite frankly, you'll get 10 different answers from 10 different people who had 10 different perspectives. It's got to be you and where you're looking to go to, and then perhaps work it backwards.
And can I put in my 10 pennies there? I think there are a lot of questions you need to ask yourself, because I think these things are very personal. So lots of issues. Where are you in terms of risk and your age? So for example, I'm an old bloke, so therefore, and I built up assets, so I'm fairly risk averse. If you're younger, you may be happier with risk. Do you want a full-time job, or do you want a hands-off investment? It's very different if you're going to do this full-time and manage the property yourself. So if it's an HMO, as Teresa says, you've really got to know your stuff. On the other hand, if you're planning on using an extremely good manager, you can outsource a lot of these things. So I think there are a lot of questions you need to ask yourself. As it's been mentioned, where do you want to go? What's your risk? Do you want to have a full-time job? These kind of things. I don't think there's a right or wrong. Just to give you an example, yes, everyone should start with a simple buy-to-let. I didn't. I started with an HMO and commercial conversion, and I made my mistakes. But I just don't think there's necessarily one right reason for everybody. So ask some questions, ask around, and find out something that's right for you, your particular circumstances. There are so many options.
I'm just going to chip in, if I may, on that one. I heard that Teresa talked about getting straight away into HMOs the hard way, and therefore maybe starting on a smaller scale. I also just recording a conversation I had yesterday with Mike Baker, who is an astronaut, funnily enough, and I had a one-to-one with him. And one of the things that, well, my family did, but one of the things that he said, which was pertinent for property as much as anything else, is do what you're passionate about. And so I attended a property investment course. I learned about single let developments, HMOs, service accommodation, etc. And if I'm honest with you, when I invested in HMOs, I really hated it. I just didn't like the type of property. People make a lot of good money. I know Bronwyn is a fantastic investor in HMOs. So it works for Bronwyn, but it doesn't work for me. I much prefer to do service accommodation or single let properties that are micro flats that I build and then I rent out. So I think you just need to be a bit careful, I think, in terms of watching what everyone else does and saying how much money they make, because you might make money, but you might be miserable as well. So I would kind of finalise on that point, but probably you're going to say something else as well.
Well, I was just going to say, actually, the sound isn't great from my end, so I don't know if anyone else can put into their chat box if they're struggling to hear or not, or whether it's just me because I'm in Africa. So, did the rest of the panel manage to hear that? Yeah. Okay.
I
fine.
did.
Good.
Yeah.
That's good. Okay. Not a problem. Let's move on.
Okay, let's go to another question. Again, this was someone that asked a question later before. Bala is saying, I'm getting into best and final bid offer on a property with 2 other cash buyers, which is always a tough one to beat, with damp and roof issues. If only we had Ross here. Have lost out in the past. Is there a way to secure property in this scenario? I mean, that might be a good one for Bronwyn and Tim to get involved in with that one. What's your thoughts?
Perhaps I can start with the basic legal stuff. And the 2 things you need to know are exchange and completion. When you exchange, you form a legal contract with someone to buy a property, but you don't own it. You only own it when you've actually completed. Now, in rare circumstances, you can actually have exchange and completion on the same day. More commonly, they're 14 or 28 days apart, but sometimes they can be a long way apart. So there are various options here, which depend on your circumstances. I think probably Bron will give you more details. There are options, lease options, and there's also what's called delayed completion. But in essence, you have no control over that property until you exchange, and you don't really own it until completion. Bronwyn.
Okay, so best and final bid, I've done a few of these. It's also known as sealed bids. So the way to really be up there in the decision-making process is not on the amounts necessarily. It's on your ability to exchange, your ability to complete. And so what you need to be able to do is to build a rapport with the agent, so the agent knows that you're able to progress this. You need to make sure with your mortgage broker that you have a mortgage in principle you can show. You have a copy of your bank statement showing that you've got funds. And this is so important because, especially with motivated sellers, they want certainty. So it doesn't matter if you bid 10,000 more than somebody else. If you haven't proved that you can complete, and the other person has built all that rapport and has provided all that evidence, then they may not go with your offer, even if it was higher. So that certainly happened to me in the past. So build that rapport, build that relationship, really understand what's happening with the owner of that property, understand their situation if you can. Don't go in cold. This is not just about price, okay? Cheers.
I don't know if
Next
anyone else has any
question.
thoughts on that one. Shall we go to the next question? I think. So let's go to. I just want to get to a live question because there are people are posting questions already. So if you are watching live, here's the first one from you guys. So this is I have a portfolio of properties. I don't have any income apart from property rental income. How easy is it to get a personal LTV buy-to-let mortgage at 75%, which is a normal standard rate, normal value, I would have thought. Simon, what's your thoughts on that one?
Yeah, absolutely no issues whatsoever. If you know where to look and the right lenders to speak to, totally no problem.
I love your short answers. That always puts me under no pressure at all for me to line up the next question. Even padding out
we
for
always
a
have
few seconds.
left over at the end. Anyway, don't we? We always run over. So, well, we don't run over. We always have questions left over. So yeah, short, sweet.
Perhaps I've oversimplified that. To me, that is a really not too difficult thing to do. But for a number of brokers who don't really know investment properly, or the more complex lenders out there, yes, it does kind of fox them a little bit, to be fair. But yeah, should provide an issue.
And I guess the other side to that as well is someone, because we advise our clients, and here's a dichotomy of everything. We advise our clients to be very tax efficient. And if you're doing the same on your tax returns, you may not be showing anything on your tax returns. Like I wasn't showing anything on my property portfolio income for about 6 years. I kind of boasted about not paying tax, and then I couldn't even get a home. Never mind a buy-to-let mortgage. So is that situation something that people need to be aware of, tax versus mortgages?
Yeah. For investment purposes and investment mortgages, it's definitely something you can get around relatively comfortably. For personal mortgages, it's an awful lot more difficult, as you well know. But yeah, the likes of Handelsbanken, if you've got a large deposit but retained profits within your company, can help out potentially. Not individual advice, I should say.
No, that's good. That's good. Let's go to a different house then, which was the one we spoke about. Let me just find that again. So I think this is from Bala mentioned. Yeah, so Bala, I'm getting into a best bid. Oh no, we also talked about that, so I don't need to talk about that one. Let's go to a different one. Matthew has asked a question again. Someone who asked this question before. This one answered. My current house where I live would make a good HMO. Could I remortgage it to a buy-to-let and move out into a new home? I'll talk about tax in a second, Simon, because I know you love tax, don't you? But let's think about mortgages for a second. Any issues with remortgaging?
That is a minefield. Yes, you potentially can do it. However, you'll need to really, really carefully check the T's and C's of the current mortgage that you have, and also any potential HMO mortgage. Because, of course, I'm assuming you've got a mortgage on there. It's a residential mortgage, and it will say that you need to write and ask permission to carry out works to the property. If you're now changing its usage for which the mortgage has been granted, there's a probably good chance that the lender's not really going to be up for that. So yes, you can do it. You probably will need to do a bridge first and buy your next house to go and move into. So it's a bridge to let, carry out the works to turn it into an HMO, and then remortgage it off the bridge at a higher level, because hopefully you've created something that's worth more than you left it, is how I would suggest you do that, and not fall foul of lender T's and C's, which is really quite easy to do if you don't realise you're doing it, to be fair.
Okay, perfect. From a tax angle, because Simon Hodgson, I know you're dying for me to say. So if someone has got a home that they converted to a HMO, not a problem. But if you are thinking about buying a home, did you realize that you have to pay the 3% SDLT higher rate in addition to the standard stamp duty land tax rates, which is something that people fall foul of. So some of the things in general, I talk about this, it might be better to sell your current property into a limited company, and that way you might well end up paying less stamp duty land tax if you do that transfer and then buy a home back in your own name again. So it's just worth thinking about that from a tax angle, never mind a mortgages perspective. So always interesting. So a good question so far. If I may, panel members, I'm going to go to a different question. We're flying through these questions. We'll be done by half past at this rate. So let's go to a question from Alan. What are your views on getting overseas investments to expand my portfolio? Should I make use of contacts in China? I'm looking forward to this one because I am doing international property investment. So anyone, any thoughts on that one before I kind of put my penny's worth in?
Well, who here has got investors who live overseas? Okay, so I have
so Bronwyn, you've got a big one, haven't you?
So
go for it.
I have an investor in Australia, so I think what you have to understand is the situation of their sort of moving funds and things. So it was really important to us with the Australian investor that their funds were sitting in a UK bank account. Otherwise, it's actually really difficult with Australia. However, you want to talk about China, and I know Simon's got views on that. So Simon, why don't you talk about your understanding of China?
I think for any country, for that matter. So I think the one big thing that you need to think about is if you are working with a joint venture partner anywhere in the world, legal matters, because the legal construct in the UK may well be governing theirs. But if you're in America, for instance, they ignore everything that we say in the UK. So Americans don't have to look at our legal constructs at all. It potentially is, well, where do the boundaries lie? And I'm not sure if you've had issues with that, Tim, but it's difficult to overcome. There's financial regulations as well. So financial regulations from China, money coming into the UK and back out again. Are there any issues from a financial regulation perspective, especially when it comes to anti-money laundering? So you need to could be considerate of all of those things. So then finally, when you are paying money out to them, how on earth do they receive it? Because technically speaking, if you get money from a limited company, it could well be something whereby it's taxable, or it may not be taxable at source. And you have to agree that with the joint venture partner. So if you agreed, oh, I'm going to pay you £1,000, but then all of a sudden you've deducted £200 worth of tax from them and only given them 800, that could really upset that relationship. So I think anyone working with people abroad, understanding, like in the UK, no different, is to think about law, is to think about tax, and then it's to think about how on earth you work with them. Time differences and kind of not being able to, see face to face together is very, very difficult.
Yeah. I mean, just one more thing. So for us, it tended to be in a loan situation, not joint venture. But when we pay back the interest, what we have to understand is we need to withhold a percentage of that for HMRC. So that's another thing. So if anyone wants to talk to me about my experience, fine with that. But I think Simon's out. Say again. Can you hear
Mr.
me?
Hodgson, anything from your perspective?
Yeah, there will be all sorts of AML that trip up. I mean, usually the AML, well, it's performed in two places, by the lender in underwriting and then the solicitor doing conveyancing.
Anti-money laundering, AML.
Yeah, sorry, used that acronym, didn't I? Assuming everyone one knows. And the thing with anti-money laundering regulations and guidelines is they are just that. They are there for interpretation. So different lenders have different interpretations of how they will work with that. So some lenders you will be able to work with money coming from China, some you won't. And then conveyancing, it might well be that the solicitor on board will have a different view. So marrying those all up can be quite a challenge. Not impossible, but just bear in mind that it's not as straightforward as just the money turns up in your bank account and off you go and you use it. It's an awful lot more challenging, I've found.
Tim, just on the legal point, if you've got someone from one country working with the UK, how on earth do you protect one another from a legal perspective?
Well, certainly, I think Simon's right. The anti-money laundering is crucial. I don't run cases, so I don't get involved in this on a day-to-day basis. But we did an example last week, and it came to me, and we had to say we wouldn't be able to help them because the circumstances were, it was, I think, an Eastern European chap, if I remember rightly, who was in England. He had money back in wherever it was in Eastern Europe, and he wanted to somehow find a way of proving where it came from. And so he's coming up with this complicated arrangement whereby he was going to sell a property in Eastern Europe to his friend, and somebody else was going to transfer a property over him to here, and then he'd use that as the cash. It was no way was it going to stack up as far as we were concerned. We simply just said there is no way we will be able to put that past the AML, the money laundering regulations. We need to make sure we know where the source of funds are. Otherwise, we're responsible. So yeah, if it's awkward or difficult, you're going to have to look at that. Solicitors will deal with it on a more detailed basis, but that's just one example where it was such an extreme example. We had to say, no, we can't help you on that basis.
Yeah, that's an interesting point, actually. Let's move on to another question. This is someone else who's just asked this line. Obedem has said, I have just put an offer on a 3-bedroom terraced house, but I understand the house will still remain on the market until completion. What can I do to make sure I have this property in my portfolio? Which is very similar to what we said earlier, but maybe this is getting to a stage whereby it's not there on completion. It's pretty much exchange, possibly gazumping. That's the thing, isn't it? So again, over to you, Tim, first, and then Bronwyn second, to see how you might protect yourself from that.
Yeah, I think I kind of half answered this last time because I'd read ahead of the questions. But yeah, absolutely. Just to go back to where I was before, on exchange, you have you're committed to buy it. On completion, you buy it. So the only way to actually make sure, the 3 options, you can have a lease option, an option, or delayed completion. And I know there's another question on delayed completion, so I'm going to cheat here by answering that one as well. Delayed completion is when you've exchanged. So in the normal way, you exchange, so you commit, you pay a deposit, and you commit to buy a property from someone else, and they agree. And so that's all very well and good. But normally you put in a completion date, 14 or 28 days off. Now, sometimes there are circumstances where that doesn't work, and there can be numerous examples. Sometimes, for example, the vendors want to spend time looking for the property. Another good example is planning permission. Often people buy subject to planning permission. So if you don't want to buy a property that you can't develop, one way of doing it is effectively with delayed or a conditional contract, whereby you do exchange and prepay a deposit, but you don't have to complete unless planning permission comes through. So that is another form of delayed completion. The only other options are lease options, whereby you have the option to buy the property in the future, but in the meantime you lease it, or an option to buy when you simply pay, again, for an option to buy something in the future. In your case, probably it's all about exchange. You need to exchange, and that's the only way you're going to get the property guaranteed. So I don't think there's that much else really that you can guarantee. Otherwise, there's always a risk. Gazumping and gazundering are two common phrases. Gazumping is when you put an offer in the house and everyone says, fine, we'll accept that. But before it gets to exchange, someone else puts in a higher offer, and there's nothing you can do about it. Gazundering is not very common unless you have a declining house market. It's the reverse, where someone actually accepts a lower offer. But gazumping is a risk, and there's nothing you can do about it. It's perfectly legal unless you actually exchange, or you have an option.
Unless you live in Scotland. So if you're in Scotland, it's slightly different process. And I coach a lot of people in Scotland, believe it or not, and their system is really good. So when you offer, actually, it is a legal contract once your offer is accepted. So you can't get gazumped. You can pull out, but you will have paid some money already. So it's a much better system, I think. But in terms of this question then, it sounds like it could be a repossession, because I know houses that are repossessed, usually the bank is asking agents to act on their behalf, and until you exchange, you don't have certainty of that, because someone else can come and offer more and exchange quicker. So yeah, I'm not surprised it's happening. I just think, yeah, in this current marketplace, you do need to have everything lined up. You need to have that pack that you've got, which says, yes, I have the funds, yes, I can get a mortgage, or indeed have a cash investor in the background, because hey, you can exchange pretty quickly if you're buying in cash. So I've bought a repossession in the past, and I absolutely needed to be a cash buyer. And I had one investor. The investor put all the cash in. I created an HMO, refinanced it, gave them their money back with an interest amount. So that's where you need to get really clever, I think. Do some learning with me. How do you work with investors? And this won't be an issue for you. So.
Bronwyn, I've just read the response. Apparently it is a repossession, and that is relevant to Bronwyn's point about exchanging quickly, because with a repossession, often you can move to exchange quickly, and there's a reason for that, and it's a dangerous reason. Normally, the whole point of a solicitor is he's checking your title, he's checking if there are any problems, if there are any issues, searches, all sorts of things to make sure you're buying what you need to buy and you know what you're buying. The big problem with the repossession is the person who's selling it is the bank. And the bank knows virtually nothing about that property. So they have no idea if you've got awkward neighbours. They have no idea on planning issues. So as a result, the bad news is you have to do a lot more checks yourself, because you don't get that information provided by the vendor. The good news is, because your solicitor cannot check with the other side because they know nothing, you can probably move to exchange quicker.
Very good answers. And I think we covered a lot of ground there. So that is brilliant. Hopefully you found that useful over them in terms of our responses. Just go to a different question, if I may. So this is someone who answered previously live. Again, this I think was Matt. What are the pros and cons of go for an interest-only mortgage? Are they available for everyone? Before you answer that, Simon, something that Matt was asking before was having a residential mortgage only as well. So is it possible to get a interest only on your home? And then what's the pros and cons of getting more interest only on a buy-to-let?
Oof, okay, wow, that's a myriad of answers there. So first of all, I should caveat this answer with that I don't arrange personal mortgages, okay? However, yes, you can get an interest-only mortgage on your personal home. It generally is at 60% loan to value or less, so you've got to put in a large deposit, and you have to have a very robust repayment method for that mortgage when you come to the end of the term. And the lender will really want to understand how you're going to repay that, why, if you're not taking out on a repayment basis, what the repayment method is, etc., etc. I'm not going to go into the pros and cons of doing that on the house that you live in, because there are many arguments either side. But if we stick to investment properties, are interest-only mortgages available for every investment mortgage? Yes, they are. Are they widely used? Yes, in general. The idea of the interest-only mortgage is that it then makes your cash flow the maximum it can be, and you are potentially looking to get longer length interest-only mortgages, so 25, 30, 35 years. There are some lenders even out there that will give you a 35-year term as long as you are less than 85 years old at completion. Wow, that's pretty old, and you're not likely to see that mortgage out no matter how healthy you are, to be fair. But yeah, in general, what you're looking to do is preserve your cash flow. Now, what's worth bearing in mind is with an interest-only buy-to-let mortgage, you can overpay by up to 10% per year without any redemption charges, early redemption charges. So you effectively can make an interest-only, a repayment-type mortgage if you want to. When you come to review your tax position, couldn't help myself there, Simon. So what you would do is you'd have an annual tax meeting before you file your tax returns, and you would decide whether you've been particularly profitable or not, and you might look to then pay down some of your mortgages. But don't forget, with a lot of investing, we're looking at inflation. Now, inflation is really high at the moment, but inflation generally doesn't run as high as it is currently. However, inflation is kind of our friend as an investor because it erodes the balance of our mortgages. And if you look back 25 years, if you're old enough to have investment properties from 25 years ago, then you will, the value of your property has gone dramatically, but your interest-only mortgage has stayed the same. So effectively, your loan to value or debt to income has massively changed. So a lot of people will start out with interest-only to start with, and then maybe start to review after 5 years, looking at starting to pay down some of the debt. And that is a massive question. I'm a fan of paying debt down over the longer term, but certainly using interest only to get your cash flow up. I'd be interested to hear what the other panel members have to say.
Who else here has interest only mortgages? Teresa does, I know, yeah. So we all have, interestingly. It's one of the questions I get asked a lot around, isn't that really risky? But as Simon's explained, not over the long term. Teresa, any views on that?
Well,
you're on mute.
Yeah, can you hear me now? I mean, I basically went on interest only because it's a long-term plan. It wasn't just for a short period of time, and it doesn't really matter, because of the cash flow that I'm getting off the property. It easily covers a mortgage. So yeah, I was happy to go on that.
I just on that point. I'm not sure if Teresa finished on that point, but the one thing I would say is for every £100 that you pay off your mortgage, you pay 40% tax. Why is that? If your net assets is more than 325,000 for an individual, debt helps you reduce inheritance tax because you are only taxed at IHT on your net assets. So the moment you are in the IHT threshold and you're paying 40% tax, which is traditional the value, for every £100 that you pay down in capital, you will pay £40 of tax extra. So do think twice before you pay down your mortgages. Funny enough, a CPA who I talk about to in the US has the same kind of principle. You buy a property, you refinance a property, you die with the property. So the idea behind it is that you just keep on refinancing it to increase your debt. So there you go. So that's another good reason. Just keeping on that theme though, Simon, get you back. Here's my slam dunk Djokovic serve back to you, sir. But here's a question for mortgages. Carrying on from the theme, are there buy-to-let mortgages at 85% LTV, and are these products worth it from an experience, I guess? Whilst you're answering that, I'm going to dig up all my other mortgage-related questions. So you chuck ahead with that answer.
Love it. Well, here's my Nadal backhand straight back at you, all right? Okay, so 85%.
By the way.
Right, 85% loans to value mortgages. Yes, there are some out there. Not as many as there were, clearly. I'm going to try and explain this as well as I can. So bank sweet spots are at 75% loan to value. They've typically rested at that level post credit crunch 2008, as we went through that. What you tend to find is that lenders will price their mortgages in this way, and this is the bit I'm trying to hopefully explain correctly so that it's understandable. Let's say, for argument's sake, you've got a 75% loan to value mortgage and you've got an interest rate, for argument's sake, at 3.5%. That same lender will offer you a higher loan to value, i.e. you put less money in, but they'll increase the interest rate because technically to them they've priced in some additional risk. And let's say that the interest rate goes from 3.5 to 4.2, which wouldn't be massively out of the realms of possibilities. What you will tend to find, if you calculate what your additional monthly mortgage costs are per month and you hold the mortgage for 5 years, you will generally find you have ended up paying back that lender the additional 5% that they saved you in deposit money at the outset. So you would only use this kind of thing if you were really trying to gear up and momentum invest, and or you hadn't quite managed to add enough value to the property that you'd refurbished to be able to take out a 75% and recycle all your cash. I'm hoping that I've not run through that too quickly. That's not to say you shouldn't use those products, but just be careful, especially if you're relatively new. You're gearing up on debt is not too high on debt, can be quite a difficult thing to do. You know, let's say you've done that, you've taken on some credit card debt, some personal loan debt, suddenly you are at 100% loan to value. And if there is any change in the market, you've got very, very little maneuverability.
Can I just come in there again? Things change over the years, and obviously at the moment we've got a reasonably strong economy. But certainly, I'm sure all the panel members and a lot of people listening will remember negative equity, a particularly nasty thing, less common at the moment. But if you take up a high mortgage like 85%, if your property drops by 15%, or if it's overvalued, suddenly you find you're in negative equity and you can't sell, and that creates enormous problems. There are many people who got into major problems last time by over gearing. And I think sometimes the property community can be very keen to massive gearing. By gearing, I mean your percentage of your debt to loan. And I think there is a danger. And once you get up to 85%, it's not too bad. But I know sometimes previously, Simon, they were available at 95%. And that was just a hostage to fortune as far as negative equity. So if you're risk averse like me, do be aware you are at risk of negative equity.
Simon, just to answer that, we did a webinar, did we not, talking about recession? In what recession did property prices ever fall below 15%?
Absolutely, we did. Historically, we looked at a number. The only time that property prices dipped, I think it was, wasn't it, below 15% from their peak, looking 6 months after when the peak was, or when the R started, the recession, was the credit crunch. Otherwise, if you look back at 90s, 80s, yeah, literally within 6 months, property prices are, I think, was within 4% of where they crashed from, wasn't it, Simon?
Yeah, there was a maximum of 4% from the 1980s.
Phenomenal, isn't it? Who would have thought? So we were kind of covering how great a property investing in property is compared to everything else that you could currently invest in, which is, yeah, you've got to be risk off at the moment. Any kind of investment, stock market, bonds, equity, it's just, yeah, risk off.
Right. Moving on. Okay, so a question that's really interesting, and this is interesting because I posed this question to you guys. It wasn't Tony Fung. Tony, I appreciate you asked the question last month. We didn't get around to it, but here it is now. Or a question you've asked is, with no fault eviction being removed soon, I'm thinking about moving to SA, but legally, is it more friendly to a landlord? Before we get on to answering that question, because this is a big topic, I have to be honest with you. Tim, Teresa, you start on this. What is going on with this no fault? Is there any way that landlords now can take possession back from a property, and what scenario would that be?
Right, yeah. So basically, the government are reforming the whole, sort of rental processes, if you will. And currently, a landlord can gain possession back of the property using a Section 21, which basically is a no-fault eviction. And a lot of landlords do use that route, because even if there are genuine issues, for example, you know, antisocial behaviour, not paying rent, and so on, it is so long-winded and difficult and complicated to go through the court process that, you know, landlords just think, well, instead of, you know, it going to court and then a judge then making a decision which may go in my favour or not, I'm just going to go with a no-fault eviction. And especially with antisocial behaviour, it's so tricky to nail down and, you know, prove that you have got, you know, you've got an issue. So the government basically are going to remove the use of that. But I would say we are such a long way off it. I mean, they're so behind on their schedule to basically remove the Section 21, reform the Section 8 route, where you have to apply with a specific ground to get back possession. So they've got to, you know, they've got to sort all that out, and oh dear, it's going to take ages. But I suppose it's quite correct that, you know, the person asking the question is that, yes, it is going to go. So it is going to make things more complicated. Well, hopefully not, but yeah, it's going to be more difficult.
Yeah, the NRLA have done quite a lot of lobbying on this, haven't they, Teresa? If you get a chance, can you pick up a link and send it in? Because I think there's some really good. There's a really good place to look at on the NRLA website around this topic. It's way too big for us to really do it justice here.
Well, this is it,
but let's come back to the question. Yeah, let's come back to the question. I'm thinking about moving to South Africa. No, I'm thinking about moving my strategy to serviced accommodation. So for the beginners here, and I often get told off, you know, stop using jargon. SA is serviced accommodation, so that's short-term letting. So it could be holiday lets, it could be letting to builders, tradespeople, that sort of thing. So if he's moving to a different strategy, which is short-term, legally, is it more friendly to landlords? What's my legal standing? Okay, so yes, you know, you don't have a contract like you do with a buy-to-let situation, single let, where you have an assured short hold tenancy. With serviced accommodation, it's a very different arrangement. So you can ask people to leave. You don't need to have a reason. I don't think it's just about being personable, but if somebody's not behaving, you're perfectly in your rights to say this is not in accordance with a holiday let or whatever with the neighbours. You need to leave. So I do a lot of guest houses, so we often ask people to leave, I'm afraid. So
well, it's not their own, it's not their main home, is it? And you know, you have access into their room. You've got a key and you can go in their room. It's not their private accommodation.
Yeah, exactly. You would never do that, obviously. So yeah, there are rules there, and there are laws to protect the tenants, and landlords need to be very aware of those, or use a good agent, which is what I do.
Coming on to someone who's obviously a legal professional and a property investor, Tim, I mean, when this has come about, what's your initial feelings and thoughts about your own portfolio and this particular change coming through?
Well, in terms of my portfolio, I don't have any. Well, I actually have 2 ASTs, but yeah, I guess there are problems. I think what's very clear is the governments are going to gradually move against landlords. We're not popular at the moment. Government is getting into bigger regulation. So I think one thing you can guarantee in the next 10 years, you're going to see more regulation against landlords, whether it's restrictions on service accommodation or the kind of things we're seeing now in terms of making it harder to evict people. I think that is merely the first step, and unfortunately none of the political parties seem to be very keen on landlords. You know, we're not very popular, the press likes going for us, and so I'm afraid to say this is merely, I think, the first in a whole wave of things that will gradually tighten up bit by bit. It'll probably, things going into fashion wherever, it may turn back eventually, but for the next 5-10 years I wouldn't be surprised to see a series of tightening of restrictions on landlords, more use of licensing, more restrictions, more pro-tenant stuff as well. So this is merely, I think, possibly the first of number of changes. it'll drive some people out, but on the other hand, we'll end up probably with a more profession of people who are landlords on a bigger scale. But I think some people have got one here and one there will probably struggle increasingly to cope with the legislation and regulation, which is going to increase.
I'm typing a question in because I'm combining questions at the minute very swiftly. And I'm going to put in here this question set, which is combined from two people, and I've abbreviated it, so just bear with it while it comes up. Gary's asked about this is REARS. I did say I was rushing to get this done, but I saw it on WhatsApp and I thought let's dive in because it's related in part in terms of legislation. And now we've also got Gary who talks about the increasing interest rates. We've seen that. We might see more interest rates in going further. Lucy also talks about, well, utility prices are going up. I mean, people looking into property, people would be saying, especially your friends and family, this is a classic video that we did last month of your friends and family will tell you no, they'll use these reasons. They will say, well, legislation's against you. The interest rates against you. Utility prices against you, you'd be crazy to invest in property. And that's my point when I say, well, that's where Warren Buffett comes in nicely. And I'm sure, Tim, you remember this phrase, whilst everyone's fearful, you grow strong. You make sure you invest. But whilst people are going crazy, I appreciate I've totally ruined that phrase. But the idea behind it is people are growing fearful. That's where you should grow. You should now invest. Panel members, would you agree with that? That I think that people may be fleeing this marketplace, and actually we should be rubbing our hands together. Bronwyn, do you want to start?
Yeah, of course. So yeah, we've always got challenges. It's what being an investor's all about. Whether it's property or anything else, you've always got to be aware of the marketplace and what's happening. I always go back to the fundamentals, however. Property in the UK is scarce. We're not building enough housing. We've got huge demand and our population has grown hugely over the last 10, 20 years. So we know there's a huge demand for rental. In terms of interest rates, as long as we can provide, and get mortgages at a certain cost and make a profit from the rental, and we get a return on investment that we calculate, then why wouldn't you do it? You have more control with property than you do with stock markets and crypto and other forms of investing. And at the end of the day, you own an asset that over the long term is going to grow in value. Now, Lucy's point about utilities, let me quickly touch on that before someone else steps in. But utilities, you only pay the utilities if you're doing things like serviced accommodation, holiday letting, or houses of multiple occupation. And for those properties, you can fix your utilities in advance. It doesn't really protect you for very long, because they have gone up so much this year. So I use a company that I'm happy to share if anyone wants to know, that actually provides a service to me where, on renewals of utilities and also meter readings, they will step in and they'll do the work for me. So there are ways of managing these things and using experts around you, which is why we're all experts in this room now. So any other views? I'm sure everyone else has got a view.
I certainly have. I've got a view on just about everything, if you really want to know. I think one issue here is it depends what you're looking at to get out of property. I suppose there are two differences. There are people who trade property and people who invest. If you trade property, there are risks in short-term prices going up. So if you're buying at £10 and you're selling at £9, you're not going to make money. If you're investing, it's a totally different mindset. And I think that is long-term. And I don't think with regard to buying, provided you buy the right property and you handle it reasonably well, I'm still confident that property investment for the long term is an extremely solid form of investment, as solid as any. And going back to Warren Buffett, who Simon mentioned, Warren Buffett is perhaps one of the greatest investors the world has ever seen. He's worth enormous numbers of billions, and he's very keen on property because basically it's long term. But he thinks all his businesses he go for are long term because property will go up. Some things will go up and go down. Property may go up and go down, but if you're looking for it long term, that's not a problem. As long as you're getting a good return, the fact that the property goes up and down almost is irrelevant. If you're looking only at the income. So I think it's a question of whether you're trading or investing, provided you have proper margins. So if things do go pear-shaped, and things will, there'll be more regulation. Prices will go up and down. Interest rates will vary. I think, again, people as old as me remember when interest rates were 15%. I paid 15% on a mortgage in the 80s. So people who moan about it going above 1%, you really don't know you're born. So you've got to expect things to change. And if your margins are tight, you're at risk. But if you're going for long-term investment, then I think it's an extremely solid investment. I continue to invest and I will carry on.
And for those of our viewers who didn't realise, that's the commonality between Mr. Tim Bishop and the star of Top Gun. They both had mortgages back in the 80s. Oh, I couldn't help myself. Sorry, guys.
Oh, yes. He's on form today, Simon, aren't you?
And like Top Gun, there's now a new target in the house. You, Mr. Hodgson, I have to say. Right, let's get before we do any flybys. Let's go on to this question, shall we? Regarding buying up at repossession, is it normal, negotiable? Are the receivers obligated to put it on open market, or can I do a deal before it goes to open market? Now, for you in the US, you can stand on the steps of the courtyard and you can buy someone's property before it goes to court, even in the few minutes before it's meant to go to court. So there you go. If you want to do some lovely repossession stuff, you can do that on the steps of courts in the US. However, in the UK, not the same. So, Tim, let's start with your views. What can you do here?
Well, ultimately, I think the thing to remember with the repossessions is the lenders only want to get their money back. So all they're really concerned is getting whatever they loaned back. Anything else goes to whoever they repossessed potentially, or to the if they got into bankruptcy, the people who are handling that. So they don't always push for the highest price. As to whether they'll take a bid in advance, I don't know. I guess that's dependent. I'm not sure there's any legislation on that. I'm not aware of that. But really, they just want to shift the property at a reasonable price and get their money back. Bronwyn, you're nodding at that stage. Do you have some more detailed knowledge about that?
So as an ex-banker myself, repossession is very much the last resort. But basically banks just give it to a third party, and they're just asked to get the highest price they can possibly get at that moment in time, because it's not only to repay them, but it's for other creditors usually. So yeah, it's the process. I think, I don't think it's changed since I was a banker. I think it's, off you go do that. Their instruction to the estate agent, who doesn't get a huge fee, by the way, not compared to what they do for private clients, is, get the best price. It's the race to exchange. So whoever is able to exchange at the highest price wins the game, and the banks aren't interested in negotiating. They just give it to a third party. It's not their expertise. So no, not really negotiable. But I think Simon Hodgson might have a view.
I was going to add in there, I believe they're duty bound to market it for 6 weeks. So even if your offer is accepted, you can be racing to exchange and complete, but they need to have adhered to that 6-week marketing procedure, so that if the transaction is challenged in any way, shape or form, or if it's a bankruptcy that is the proceeds of the repossession is also challenged and they try to unwind that, they then have a legal standing that they have effectively marketed the property as well as it could be, and they've got full open market value before they let the transaction complete.
Great. Where is Ross? We need Ross to come back. We've got a few questions for him, I think.
Yeah, I've had to reply, say we can't do it, unfortunately.
I think I can ask the bulging walls one.
Okay, do you want to, I can't find it now, so do you want to say what the question is, and then we'll do that?
Yeah, somebody said there's a property that they're looking at, or they've got, whatever, it has a bulging wall. What's the likely issue? So I bought a property that had bulging walls. It had all sorts of other problems as well. And thanks to Ross, I was able to understand it. So basically, an older property, the way it was built, quite often, they have these things called wall ties that actually tie the front part of the wall to the inner wall, because there's a cavity in between. Obviously technical term, Ross is going to destroy me after this. But so these wall ties sometimes over time corrode, and if they're metal, they corrode. And what happens is then the walls sort of start to bulge at one side. You can see it when you're looking down. I bought a very large property, converted it to flats, and you could see when you looked from one end down to the other that actually it bulged. So it's perfectly possible to put that right. We have a bit of scaffolding and some experts to actually put those right. They put in new wall ties and actually sorted the problem out. So anything like this, subsidence, I love, because it puts a lot of people off. Surveyors go, oh my goodness, that's going to be expensive. But it means you just negotiate the price to take off the costs of doing that, and you're in a much better position to negotiate. So if you want a more detailed response, then I'm happy to put you in touch with Ross separately. If anyone's got technical building stuff, just email me. Okay.
I had problems with wall ties as well. Must be my age, with bulging walls. No, actually, when I bought my house again in the 1880s, actually, yes, we had wall tie problems, and we brought it up. And as a result, they before we completed, they actually replaced the wall ties and did a lot of repointing. So we didn't pay for it. That was in the price as part of the deal.
Wow, there you go. Let's get to a different question then, guys. Thank you ever so much for your great responses. And if you are live, don't forget to ask your questions. I think we're heading towards the kind of the third end of our show tonight. So get your questions in if you can. Here's a question that's an interesting one for you, Tim. I have two clients who own property in a building. Their previous freeholder sold the building onto one proprietor and run it as an apart hotel. They haven't received rent for a number of years. It does go on to say or ask the question, Tim, what do you recommend next? So anything that you can share on that one at all?
I'm rather slow at picking this up. If they own the property, they're paying rent. We're talking ground rent here? It's not very clear.
I'm assuming so. Let's just get back to that question. That's the question.
So property in the building. I don't quite get it, because the freehold, if the lease, if the leaseholders own the flat, how does the freeholder?
It's freeholder, isn't it?
It's a previous freeholder sold the building.
Yeah.
So it's the freeholder, and they haven't received rent for a number of years.
For a number of years.
If it's ground, I don't think I can think it's ground rent. Sorry, I'm not being very clear, but it must be ground rent, because otherwise, if they own the flat, why are they paying rent? I don't quite know. Okay. Perhaps if someone could clarify that, I'll have a go, but I'm being a bit slow.
Okay, no, that's fair enough.
Just email Tim.
Yeah, but wait, email me. I'll tell you what, if I put that, should I put it up in the, if I can, I'm not sure I can, or you, Simon, put my email there. If someone pings me an email tomorrow, I'll get one of my team to go back to you, yep.
Yeah, perfect. Do that, Tim. That'd be great. Let's go to the next question then. Uzi's asked a question. Good evening, everyone. This is a YouTube live. Sorry, I just bought my first investment property from auction using a limited company, but the cash is in my personal savings account. And I think, what do you do in that scenario is the question here. Simply, you would put your money into the limited company. Therefore, you would create a director's loan account between you and that limited company. And then the limited company would go off and buy the property. I think that's the easiest way of doing it. If you have a situation whereby your limited company doesn't quite yet have a bank account, then you would have a limited company. You would pay the property, and you would still have a direct loan account with the limited company. So rest assured, it would be in the name of the company, but you would potentially have to fund it. You would put it into the business bank account. If you don't have one, you pay it personally. It's still in the hands of the limited company. And in fact, that's what you've asked the question of. So hopefully, Uzi, that's answered your question on there. Truth of observer, let's just have a look at the question here. Can you sell properties into a limited company, pay no CGT if you buy another property? Is there a rollover relief for limited companies? No, is the answer to that. The only properties you can get no CGT by transferring to a limited company is your home. There is a rollover relief whereby you could sell a serviced accommodation or a furnished holiday let. By the way, they are the same kind of things from a tax perspective. There is no serviced accommodation, would you believe, in the eyes of HMRC. It's furnished holiday lets. But if you sold a furnished holiday let and buy another one, then you can get CGT deferral. So those are the only ways you could do it. So is there a way to reduce CGT moving to a limited company? Absolutely not. That's not the answer you want. I appreciate. Let's go to a question this is an interesting question from William. Let's go to this one, if it will allow me. Let's just press show. Okay, here we are. So William says, I have no mortgage on my house. Can I use the money into reinvest in property? And here's one for you, Simon. Just want your thoughts on answering this question. But I often find that people who don't have a mortgage on their own home may be fearful because of risk. But I always say, well, if you have a mortgage on a buy-to-let property, you've got a mortgage. That is the same risk if you've got it in your own name anyway. But what I always find fascinating is that people will be quite happy to use a buy-to-let mortgage and pay 3-5% interest, and they could get a residential mortgage at 1.25%. I don't get it. Any thoughts from you on that one?
Yeah. Okay. Again, not individual advice here, and your home is obviously at risk if you take out finance against it. And I don't organise residential mortgages, but yes, you certainly can use the equity in your house. You could take out a normal mortgage on it, a relatively low loan to value. You could potentially still leave it as interest only. However, make sure that you have a repayment vehicle and you discuss that with a financial advisor as to how you might put that in place. But yeah, I think, ultimately, if we look at it in terms of, yes, interest rates have gone up. However, they're still historically extremely low. As Tim said earlier on, he remembers interest rates of 15%. The turn of the 80s, last part of the 70s, they were at 17%. No, I didn't have a mortgage back then. Clearly not. Far too young. So we've got to remember that with Bank of England base rates currently set at 1.25%. Yes, banks are having to pay more than 1.25% to borrow money currently. And there's lots of talk about how it's expensive. But in general, relative terms, it's cheap to borrow money. If you are borrowing, let's say, £100,000 at 2%, on an interest-only basis, that's £2,000 per year per £100,000 borrowed. £2,000 for £100,000 to deploy potentially into an asset that's currently growing over 10% per annum. It's hard to fathom why you might not want to do that, rather than should you do that. But yeah, Bronwyn.
Well, I have this question asked, especially for people who are just starting out, like William. Sometimes it's their spouse. So I've had this where I'm coaching one member of the family, and the partner has said, "No way, you're not touching the house." I'm like, okay, so maybe we coach both of you together and help you understand, because if one of you's got knowledge and the other one, is going, "Oh, my parents told me never to be in debt, to pay off my mortgage as quickly as possible." You're in different places. So sometimes that's the reason why people are reluctant. "Oh, I won't touch my personal house." But yeah, it's a no-brainer really. If you want to be a good investor, it's the cheapest way to borrow money. So yeah, that's I think it's easy.
Yeah, totally. I mean, none of us are of younger years, I guess. But what I was thinking, I was only thinking about this the other night. My parents' house, they bought at the end of the 60s for £4,000. It's currently worth around about 400,000. It's 100 times what they paid for it. Where else can you get that? Yes, if you like the risk of crypto, yes, you potentially could have got yourself 100 times. If you're great at time in the market and you had kahunas the size of melons, But otherwise, Yeah, I love that look, Simon. Sorry, I've overstepped the mark. Beg your
Yeah,
pardon.
I think we might just stop you there. Sorry, I'm in the crosshairs of being part of the Beeb and Saturday night because I'm in Florida, obviously. If I was in the kind of more of a exuberant kind of chat show host, I might let that go, but I'm going to have to censor that comment. But one other thing I would say about what you're talking about here is, of course, tax. We have to talk about taxation, right? But talk about people that have a home. Again, if you remortgage your home, what are you doing? You're reducing your inheritance tax because you have a debt. Now, of course, you have cash in place of that, but you might want to do things with that cash and spend it or invest it, and there may be ways of being tax efficient with that. There are also options of saying, well, it's going to be cheaper than buy-to-let mortgages. Third one for me is if you refinance your property, it's going to be income that you get from your property and it's cash free. Sorry, tax free. So you're getting money from your property. You might have to live off that, and that's actually a very good thing if you kind of think, well, actually, how am I going to survive because the cost of living is so high? Might I get a job? We're going to be taxed on, and it's difficult to get a job with a different age. I'm just thinking about your parents' life, Simon. But rather than do that, actually just refinance your house. I mean, you've got all that equity in there. Take 100,000 out, go on a booze cruise. I'm going on, and it'll all be kind of very tax efficient to do. So just some thoughts for you all whilst you're.
Yeah.
Okay, I'm going to go to a different question here. This is from A. I hope that's not your real answer, your real name. So A has said, as a question here, let me just try and say that, possible to shed knowledge on care homes and sheltered accommodation. I am toying with the idea of converting an outbound into a care home. I mean, if you've got an outbuilding, a barn, and you're looking to convert it to a care home, that there's so many planning considerations and risks to your own house, surely on that. But let's just think about care homes for a second, or local authority stuff, because I know that you've done quite a lot of that, Bronwyn. So do you want to care to share your experiences and thoughts of other people doing the same?
Yeah, so we provide emergency accommodation for councils. We have looked at buying care homes, but not running them. So what you need to be very, very careful of is if you're looking at care homes, as in care for the elderly, disabled, etc., massive regulation. And this is why I've been picking them up, because they're cheap, because people are out of business, because it's so highly regulated and really difficult to run. So if you really mean that, then you need to be an expert in that type of business. Sheltered accommodation, yes, similar thing really. There are rules and regulations, but in terms of emergency housing, we provide short-term accommodation for people who the council need to find housing for in different situations. So it could be that fire, floods in their own council house. It could be domestic violence. It could be other things that mean the family needs to find somewhere safe and secure. So it isn't sheltered. It's for all people, different walks of life, but it's mainly councils. So council will pay us on an invoice and we charge per night. Now you can pick up care homes and large properties and actually create that sort of strategy. More than happy to share that one-to-one if anyone wants to talk to me about what I do from that point of view. But yes, with this question, you've got planning, first of all, and that can take quite a long time for planning. And then you've got, business side of it. How do I run it? How do I make money from it? It's a trading business. It's ongoing. It's not easy. It's not like a buy-to-let where you can, step back a bit from it. That's my first thoughts on it. Anyone else got a view? Nope.
No, I is actually saying thanks panel, not interested in running the care home, but build it and rent out to charity or council. So yeah, best to get in touch with you, Bronwyn. Okay,
so that's different. So that would be having a lease with with the charity, or the council. They do long leases. They do leases with sort of fully repairing leases, which can be really good investments. So the first place to start is to talk to the councils or to talk to the charities concerned and find out what they do, how they do it.
On that subject, if anybody's interested in doing exactly that with those kind of long-term lets, we act for someone whose business is actually putting landlords in touch with various care providers, and then we do the legal stuff. So if anybody's interested, again, my email, feel free to get in contact and I'll put you in touch with them. They act as effectively an intermediary doing exactly that.
Perfect.
Yes.
Sorry, just looking at my emails in terms of the detail.
Lots.
If you're looking for people's email addresses, by the way, it's in the description box below. So feel free to grab everyone's email address. It will be there for everyone that you talk about them.
Yeah.
I'll just go to a different question because I'm just conscious that we're now going to run out of time. That I don't want to do. And I'm just going to, there's a couple of questions I might be able to answer pretty quickly. I shall do that while we're preparing for the next one. Harry's asked, what do I need to consider company structure and specifically holding companies when you have a tax need? If you are a high rate taxpayer, then you will need a tax review to think about limited companies. I do see an awful lot of talk about holding companies. I mean, Simon, talk about this. Let's escape a little bit because I do see people willy-nilly setting up limited companies, in the wrong structure anyway. 85% of companies I see are set up in totally the wrong structure. Why? Because they go to companies made simple, get peanuts, get monkeys. But Simon, from a perspective of someone creates a holding company, then another company underneath that, so almost like 3 or 4 different layers going on. How easy is it to get a mortgage?
Yeah, it does complicate it slightly. So it doesn't mean that you can't get a mortgage. And yeah, layered company structure is exactly the right way terminology that lenders look at it. So they'll either lend to a non-layered structure or a layered structure. Yes, I would say it will slightly limit the lenders you can go to and makes you need to go to a dedicated specialist broker who understands that marketplace so that they can go out to the right lenders. But otherwise, it won't really affect your bottom line too much.
It won't, but the interest rates will be higher, would it not? And be maybe higher arrangement fees.
Interest rates are priced a little bit higher because, of course, it's a slightly less competitive market that they operate in.
Yeah. So, and that's my thoughts on that side of things. Let's go on to just trying to go through a couple of questions that I think are nice and easy to answer. This is really an opportunity for you, Teresa, just to sell, really. Someone's asked a question, so why not sell away? Peter's asked a question, what is the benefit of being a member of the NRLA? I mean, what a great opportunity there is for putting yourself on the pedestal there and selling away. So there you go.
Thank you for that opportunity to talk about the many benefits of being a member. As I mentioned before, you sign up for a year, and then you have free access to the advice line. So that's on the telephone or online. We also actively lobby and represent the landlords. So, you're doing your part for helping to shape the policies for the future in the sector. You get free legislation updates, and we know how important that is, considering the government are constantly tweaking and talking about making changes. So it's good to keep up to date with what's going on instead of just doing a Google search and being bombarded with all sorts of probably misleading information. You get free tax investigation insurance. So that's worth over £100. You get a magazine quarterly, which is a really good read on, what's happening in the sector. If you're managing the property yourself, you get access to all like the contracts and template documentation and the notices, so you know that you're always using the right paperwork. So just that'll sort of sort out any potential sort of delays in getting back possession or sorting out some issues in your property. We've got regular webinars and podcasts, so you can hook into those. You can also take training. We have online and face-to-face training sessions, these can just cover like a broad subject of being a landlord in the sector, or can basically pinpoint on specific topics, such as, you know, electrical testing or antisocial behaviour, for example, or even, you know, if you want to be a HMO landlord, you can do a course specifically on that. And then, yeah, basically there's a rep network. So I'm one of the reps in the network. So we hold webinars, and there are some face-to-face meetings going out there. And, you know, you get to find out what's happening in your local area with regards to any licensing with the council, you know, because we do have relationships with the local councils. So all in all, it's just a no-brainer, really. If you're a landlord, it just keeps your finger on the pulse of what's going on in your area and in the sector.
Brilliant. I know I've really benefited hugely, especially when I was starting out. And I used to go to those local meetings. I used to meet landlords. I used to, you know, build a network of people who were way more experienced than me. And then I used to use the logo as a member. I used to put the logo on the bottom of any email that I had, because it made me look like I knew what I was doing. So just a few tips there. Anyone else?
Yeah, yes, I'm a member of the NRA, and I have been for about 8 years. So it's one of those things that I've probably let it expire only because recently, because I'm moving out over to Spain. So it's kind of from that side of things, I am looking to do investments in the US and this Spain. So it's difficult for me, but I would say that anyone in the UK should certainly be a member of the NRLA. There are so many free resources, but it's also handy to call the NRLA just to get some guidance on certain things that you're not always sure of yourself. So I would recommend it. Okay, so just go to question and here, panel members, here we are. So Michael has asked, if one is buying a first property to let, and I'm 71, so still much younger than Tim, and can put down a deposit, I would like to borrow money which I have to be paid into rent in advance. So basically I'm thinking this is talking about getting a mortgage at the age of 71 and putting money in, is what I'm reading. I mean, I've seen mortgages being given to well, I think the person I saw on the press was about 85, 86, something like that, Simon. So what is client you've got, without kind of saying who it is, of course? And it's not, is it Tim?
Tim's got so much money, he doesn't need mortgages. I jest. Yeah, so precise, we'll give you a 35-year term on a buy-to-let mortgage, as long as you haven't breached 85 at the start of the mortgage. So effectively, yeah, you can be 120 at the end of term. You're never going to see that out, are you? Let's be honest. So there's enough lenders out there that will do it. There's a lot of lenders that won't do it. So there's a lot of lenders that are still stuck in that, okay, when you're going to retire, you've passed retirement age, how's your health? And it's generally easier, I say generally easier, if you are a director or shareholder of a limited company, that they're a little more lenient when lending into limited companies about the age, because they kind of understand there's a degree, and this leads into you, Simon, into the tax planning, that potentially there's succession planning already built into that structure anyway, and that's part of the reason why potentially they've used a limited company structure, albeit incorrectly set up by 85% of the public that do.
So I think Michael has a second part to the question. Sorry, Tim, did you want to come in? Sorry, I wasn't. Okay,
yeah,
so I know Michael was also saying, okay, over to you, Simon.
Yeah, no, it's okay. I was just going to type and paste that in. So Michael has continued. It's just make sure we get the right blocks here. So this may still not cover the mortgage loan plus any other expenses, income tax, apart from property price increase. Where's the benefit? And I guess really this again goes back to the point of what's a property investing per se. And I think we all know as investors, you make money from property, and people make comparisons to stock markets and make comparisons to gold or whatever else. But where, and Simon Hodgson said this on a previous session with me, is, well, where else can you get capital growth and income if you structure it correctly? And I think there's very few. I mean, even if you get stocks, if you go for dividend returns, you won't get good capital growth in those because the company's giving out the money, so they don't have capital growth. Equally, if you go for capital growth in shares, then you don't really get dividend income. So, property is the only one, I think, that kind of gets on that bandwagon, if I'm totally honest with you. I don't know what your thoughts are, Bronwyn.
Yeah. So Michael, it's all about understanding, where do you buy, what type of property do you buy in the right location. So this is why education is really critical here. You can't be sort of looking at your own property and going, well, if I buy another property like mine and rent it, it won't work. I think you've got to find, where do tenants want to live? Can I buy a flat or a small house in the, close to public transport, maybe towards the centre of the town, maybe ex-council? You can pick up properties where people really do want to live in great locations that are a lot less money than a house that you might be living in. So when you do the sums, go practice, have a little look at Rightmove and go, well, if I bought in this location, is there a demand? Is there demand to rent? So more than happy to have a chat. My program covers all of these things. It's so basic, but I'm really glad that you asked the question, because I can tell you there's lots of people that want to know the answer to these questions, that come along to this because they're just starting out. So more than happy to have a chat with anyone separately, apart from this meeting. So yeah.
Well, let's get on to it. This is a question I've not seen. We've been doing this now for 2 years, right? And I haven't seen this kind of questions before. Syed said, where could we source information on expected rents for commercial units from different businesses, e.g. hairdressers, nail salons, news agents? Which types of businesses are preferred? Anyone got any ideas about what you could actually charge? I'm sure it depends on the location and what you're next to, surely. Simon,
can I jump in? Simon? On a new format, I can't see how to raise a hand other than in the old analog way, actually raising my hand. So there you go. I thought I'd raise my hand. Probably one of the best and easiest places would be in your area to find a good commercial broker, because their job is to value properties, yeah, and they'll understand the rents that certain types of properties and commercial properties can get, which types of tenant, etc., pay what, etc., etc., etc. And yeah, you're going to have to pay for it a little bit. It's not going to come for free, but you'd be surprised. You wouldn't have to particularly pay huge amounts of money, and you could potentially lead it in with that. Okay, well, I'm looking to invest in this area, looking to invest in commercial property. I'm looking to find a valuer to work with to help me do that. And at that point, they're going to really then want to go, oh, great, and form a relationship. You might be able to have a coffee with that valuer, and maybe a coffee might cost you a couple of £100. Money well spent, as far as I'm concerned. And I've got valuers in and around the southwest that would be more than happy to speak to you about how they value certain types of properties, the trends, where they see the trends going, whether it is more city centre, whether it is units on the fringes of towns, whether it's large commercial, small commercial, etc. They can really break it all down for you really nicely.
Can I also add that another particularly good source would be commercial estate agents? Again, they're going to be very keen on giving you information and educating you and encouraging you to buy, because obviously it's in their interest to sell. And they will normally, if they're commercial agents, not residential agents, commercial agents, they'll normally have a pretty good idea in your locality of what's good and bad, what shifts, etc. And it's there, so it's in your interest to get a good relationship with them. In terms of the type of businesses, obviously, people are looking for the highest rent, and rents can vary 5 to 10%. It's quite common as a difference, a 5% or 10% return on your price. But one thing is important is the strength of the covenant, and by that I mean how reliable is the tenant, because there's a massive difference. For example, a mate of mine has just started buying some commercial property, and one of the properties he's got is rented out to a Tesco Metro in South Wales. Now, I think it's fair to say, I think he's going to take, say for example, he's got a 20-year lease. The chances of Tesco being around to pay up that 20-year lease, it's 99.99999%. On the other hand, if you let it out, I don't know, to Joe Jones, who's perhaps never done a business before and is setting up a bar, or as a new hairdresser, you know, the chances of them surviving 20 years and paying you if things go pear-shaped are much lower. So that's sometimes offset. So if you want sometimes the higher return, sometimes there's a bigger risk with a lower covenant, and vice versa. But if you can get something with a really strong covenant, a good, strong business, and they're prepared to pay a high percentage, then it's a cracking thing to do. But the first person I would definitely speak to would be a commercial agent. Take them out for a drink, have a chat with them, get friendly.
And as you said in the previous webinar, Tim, always make sure you get into bed with your joint venture partners. That was what you said. Anyone who was asking that question, he did that. That's a Saturday Night Live quote just right there for you, rather than a Beeb one, I'm sure. So let's get to another question here. Tammy's asked, my accountant suggested setting up a management company to associate the costs, expenses, tenancy, and legal charges, payroll, revenue to do with my properties, if it helps to use a holding company. And this is smacks in the face of GAR, General Anti-Abuse Rules, which is stopping landlords from using a limited company to get a tax advantage from the common man, is the phraseology. Bit sexist there, HMRC, need to step up. But the idea behind GAR is to prevent someone who owns properties to then charge themselves a management fee in a limited company. What you're trying to do is siphon the money from you to the limited company and then get charged at corporation tax rates instead of income tax. And that just doesn't play anymore. So in fact, I've seen a case just go through, and I've just recorded a webinar talking about a specific case whereby an accountant has advised their client to use a limited company rent-to-rent structure, and it failed abysmally, and opened up a 7-year investigation. So there you go. So amount of tax that will be charged will be phenomenal. Just going on to another question here. Let's just see if we look at this for a question. Emily is asked, if you have an unencumbered property on my own home without mortgages, you can't release that much equity if your salary is low, even if the house is worth a lot. Well, that's a good point, actually. I mean, I've not thought about that, but what's your thoughts on that? I know you don't do residential mortgages, but is there a way to get around that, like a rent guarantor or a guarantor for the rent?
Yes, there is. Again, not providing individual advice here, but Emily, if you were to have a small first charge residential mortgage on your property, the remaining equity in your property could be used on a second charge business transaction purposes to then get a second charge against your house, which isn't as affordability stress tested as the normal mortgage. And or if you're buying a property or a project that requires refurbishment and is then going to be remortgaged, you can effectively borrow the deposit from your house in the form of the second charge and borrow 75% against the house that you're buying to effectively put no money in to buy the property, refurbish it, remortgage it at a higher level, and then pay back the money on your own home. I must stress, not individual advice, and you can only do that if you are using it as business purposes, which then qualifies it for investment. But yeah, it's definitely doable, Emily. There's ways of unlocking that cash.
There's a related question in ways of people starting out in property, and this is an interesting one from Tiffany saying, would it be advisable to start a limited company when buying buy-to-lets? And I'm thinking here for general people listening in, where should you start? Should you buy properties in your own name, then a limited company? Is there not an issue with banks loaning money to limited companies and looking at experience, or is that not a thing anymore?
You dropped out at my end ever so slightly there, and I missed that.
Okay, so I was just asking the question about limited companies and whether you need, if there's any issues with setting up a buy-to-let portfolio in a limited company before you're doing anything in your own name, given the lack of experience.
No, in general, there are lenders out that will lend to first-time landlords and first-time HMO landlords in a limited company structure or personal name. might be slightly more difficult to do in generalized terms, but yes, it's perfectly possible to do that. I think really what it comes down to, and this is something that you and I, Simon, have talked about many, many times, is you really do need to examine whether buying in a limited company is the right thing for you to do. Start with the end in mind. Where do you want to be? Are you going to be full-time in property, i.e. giving up the day job, at which point potentially, after having a chat with Mr. M, you might find that buying property in your personal name, or some in your personal name and some in a limited company, might be right for you. But it's a really individual thing. I don't think there's a generalized answer that could cover that would be safe to put out on the platform, to be fair.
I had just that question asked today. When I was coaching someone today, they asked exactly that question. So yeah, it is about getting the right advice for you personally. If you're starting out, it's cheaper to do it in your personal names, but actually if you've got ambition and you know you're going to be a high rate taxpayer, then yeah, it's more complicated to set up the company. But yeah, that's brilliant.
Yeah. So audience and panel members, if you want to see a grown man cry, I certainly want you to pay very close attention to Simon Hodgson right now. And by the way, Simon Hodgson, I know we jest about Tim's age, but I think frighteningly he is older than us, but he still looks 10 years younger than us. So he laughs loudest. So Bronwyn, let's make the grown man cry, as in Simon Hodgson. What is going on with the property expert panel?
Oh my goodness. Well, we're going to have a bit of a break now. This is sort of a summer break for August, but actually we've been talking together and there's a lot of commitments, and this is a free event. However, we absolutely love doing it. So what we're going to do is we're probably going to do fewer of them, so not every month. And I know, Simon Mizovic, thank you so much for all the work you've done, because we've been going now for 2.25 years, something like that. It's amazing how he just turns up, he does all this magic, and suddenly all these questions appear. So we're very grateful for all your time and effort. It's been fantastic. The feedback we've had from people is tremendous. So we're not going to just stop completely, but we'll be doing fewer of them. But tonight, for all of those who are attending tonight, I will be emailing you and I will be doing some marketing. And that is because my online program of learning is so valuable to anyone who's asked questions here tonight, because pretty much all of these people present today have done modules. I have 23 one-hour modules on my program. I have my book, Building Your Dream Life. And you can get Property Magic book as well if you ask me nicely. You can have all my power team of connections, all their information, and so much more if you want to do some online learning. But for you guys, I've got a huge discount coming your way. So keep a look out for my emails, because I really want to keep adding value to you. And if you've attended these things and you've got value from it, you will get value from my program as well. And I will have availability of time for my members. So if anyone's got questions they haven't had answered today, send them across to me. I will divvy them out for the right people, but it could be that I can help you in terms of your learning as well. So I'm going to leave us on that note. You've got massive value from me. You're going to get a huge opportunity coming your way, so look out for that. And yes, anyone else from the panel just wants to say cheerio, but we will see you all at some point in the future. Look out for your emails. We'll let you know when we're back together. All right. It's been great to be there for all of you.
Absolutely. Just wanted to point out that's not a break that we're taking, guys. We're still going to be here. We're still coming back to you, but just maybe not quite as often. So I don't have to start crying, Simon. I'm all right.
He's not going to cry because we've got this great magic, and we need Ross back again. So we'll be complete when Ross is here.
Yeah, indeed.
Any other jokes anyone's got? We need a joke for Simon.
Well, I would say it's very similar to we're on a break. If you've ever watched Friends, where you have Ross and you have Rachel, They had a break, and that's what this is. But no doubt,
Yeah.
there will be a coming together again in the very near future.
Yes, we will be getting back into bed with each other.
Yay!
Another program. Right, okay.
Yeah.
Steady on.
Brilliant. Thank you,
Perfect.
everybody, for taking
Thank you all.
part.
Yeah,
Asking
thank
your
you.
Right.
See you
Thanks
soon.
for
Bye.
listening to us every month, guys. We really appreciate the support you've given us as well. It's great.
Yes, yeah. It's got some loyal
Yeah, thank you
supporters.
all.
Too. Take care. Have a great summer,
It's been fun.
everybody.
Yay!
Bye-bye.
Bye.